So let's take this example and calculate the basic and the diluted EPS. So we go back to our KK Enterprise where the net income was 250,000 and the 100,000 were the shares. But in this case we have 1,000 options which were issued at the strike price of 50 and the current market price is $100. So we need to calculate both the basic and the diluted EPS. So let's calculate the basic EPS first. So we have done this time and again. This would be net income minus your preferred shares divided by your outstanding common shares. So are there any preferred shares in this case? There are no preferred shares, so your net income is basically 250,000. No preferred shares, so the common shares are basically 100,000. So we take this, so your basic EPS comes out to be $2.5. Now let's calculate the impact of the diluted EPS because of the stock options. Now as you have seen this, that there are 1,000 options at strike price of $50. So let me write those nomenclatures. X, which is strike price, $50. Market price is $100. So since market price is greater than the strike price, this is in the money, and we will use treasury stock method to calculate the effect of dilution. So let's apply the treasury stock method. Now in order to apply treasury stock method, we must know what is the current market price. So we know that this is 100 and the strike price was 50. How much amount company will receive? Company receives the amount which is equal to number of options, that is 1,000 multiplied by 50. That's what the employee will do. They'll exercise their options and this would be equal to $50,000. That's the company receives. In return, employees will be given how many shares? 1,000 shares. What will the management do with this additional money? We assume that hypothetically they buy back from the open market at the market price. So how much amount that they can buy back out of this 50,000? 50,000 divided by the market price is 100. So number of shares that they can buy back is 500. So the net effect will be 1,000 options or 1,000 shares that were issued minus 500 that were bought back. So the net effect in the denominator would be additional 500 shares. So let us calculate the diluted EPS in this case. Diluted EPS would be equal to the numerator, that is $250,000. Please note that nothing happens in the numerator if there is a presence of stock options. No changes in the numerator. The only thing that changes is the denominator. So denominator contains not only this 100,000 which was the common shares plus 500. This is basically the net effect which we had calculated using the treasury stock method. So our formula is 250,000 divided by 100,500. So this comes out to be approximately equal to $2.49. So how does this compare with the basic EPS? We've noted earlier that the basic EPS was actually $2.50. So what we note here is that as compared to the diluted EPS, this has gone down. So basic EPS is much higher than the diluted EPS. So though here there's only a difference of 0.01, but we noted that the effect is dilutive in nature. So please note that if the options are in the money, then the options will be dilutive in nature and we take this in the denominator. So please make sure that we include this.